In this week's video, we'll review the charts to help us answer the question, are stocks walking down the same ominous rate hike road they did in 2015? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. During the trading session on Friday, October 21st, the market was pricing in roughly a 70% chance that the Fed was going to hike rates in December of this year. A percentage that high, for the most part, says as of this recording, the market thinks it's a done deal almost, that we're going to get a rate hike. The last rate hike we had, 2015, occurred during this meeting, the 15th and the 16th. Very similar situation this year, the meetings on the 13th and 14th. This is what happened last year. Last year, the market was anticipating the rate hike. It got weak. It made a lower high. And after the rate hike, we had a 13% plunge from late to mid-December to the February 2016 lows. This is October 2015, February 2016. Given the Fed raised rates last time in mid-December of 2015, and they're planning to raise rates in mid-December of 2016, of course, that's to be determined. It's possible for us to compare market activity and market profiles in this area here to give us some idea what do the probabilities look like. Are we going to see a similar situation where the Fed hikes on December 14th, 2016, and stocks plunge as they did in early 2016 following the rate hike? Is there any evidence that investors are concerned about a repeat performance? The answer is yes. It's a Bloomberg article, October 18th, 2016. Investor cash levels jump toward levels not seen since 9/11. Cash levels are extremely high, indicating bearishness and concern about numerous topics, and one of them being the Fed possibly raising rates in December. Typically, this is a contrary indicator, meaning most people have already moved in a defensive manner, and it could possibly allow this cash on the sidelines to fuel a push higher in the stock market, and that too is to be determined. Let's compare the profile on October 21st, 2015, so roughly a year ago, as the market was preparing for a rate hike in December of that year. This is the 100-day moving average in blue, 150 in green, and 200 in red. You can see a year ago on October 21st, 2015, this doesn't look particularly good. The fastest moving average blue is on the bottom, and the slopes of all three moving averages are sloping downward in a bearish manner, and prices below all of the moving averages. This is a concerning look and somewhat of a rollover look. Given the Fed raised rates in December of 2015, and now we're looking at October 21st, 2015, a year ago, how does today's profile compare as the market's preparing for a potential rate hike? Does it look better, worse, or about the same? The answer is quite a bit better. This is during the trading day after the open on Friday, October 21st, 2016. So we're fast forwarding a year. In the morning, we were down 11 points for the session. But the important point is this profile looks a lot better. Now we have the fastest moving average blue on top. Price isn't above all the moving averages, but it's above two of the three. And most importantly, the slopes of the moving averages are positive. It's easier to compare them head to head. So this is a year ago, October 2015. This is the present day, October 21st, 2016. Somewhat, they're almost the mirror image of each other from a moving average perspective. What does this tell us? It just tells us that the risk of bad things happening was higher a year ago preparing for that first rate hike than it is in the present day. It doesn't tell us what's going to happen. We don't even know if the Fed's going to raise rates at this point. That 70% probability could change as new economic data is posted in the weeks ahead. The moral of the story, from a probability perspective, this looks like the early stages potentially of a turn and a new uptrend, where this looks like the early stages of a turn and a new downtrend, telling us the odds of very bad things happening, a repeat performance from what we saw in late 2015, early 2016. The odds are not zero, but they're lower that that's going to happen again. We want to look at it from a simplified perspective. This is May to October, May to October. So we're looking at basically the exact same period. Let's just look at trends, price point to point. A year ago, point to point, we have a negative slope. In the present day, point to point, we have a much stronger and more desirable trend from a probability perspective. How about crude oil? Remember last year, crude oil caused all types of problems in the energy sector as well as in the credit markets, since there was so much credit, and there is credit and bonds tied to the price of oil indirectly and directly. This is crude oil, October 21st, 2015, so roughly a year ago. Again, we have our fastest moving average on the bottom, and the slopes of all three moving averages are looking vulnerable here. This is somewhat of a flattish look, and prices below all of them. This was the look a few weeks before the Fed raised rates in December of 2015. It's a concerning look, and after that, bad things happened. In 2016, we're also potentially preparing for a rate hike in December. How does the exact same chart look today? The answer is quite a bit better. Crude oil, October 21st, 2016. Instead of blue being on the bottom, it's on the top. And the slope of the 200-day moving average is turning up here. And here it had been down, and it has somewhat of a flattish look here, but for the most part, the trend was down. So this tells us from a probability perspective, in terms of getting a repeat performance in a plunge in oil, again, it's not zero, but it's probably fair to say it's a little bit lower than it was a year ago. This chart looks a lot better, including making a new high here relative to this high. Moving back to our S&P 500 charts, are there any fundamental developments that might potentially offset a Fed rate hike? This is an article that appeared on the Financial Times website this week, ft.com. U.S. earnings boost hopes that profit recession is ending. How about in the oil patch? This is from Reuters, October 20th, 2016. The near-term fundamentals in the oil market have turned positive. Demand is stabilizing. OPEC production has peaked, and global inventory declines imply that the market is more balanced than many believe. Obviously, this is to be determined, but it does give us some fundamental basis for the improvement in this chart relative to this ugly look in October of 2015. We're going to quickly review some basic concepts, and then we're going to apply them to numerous ETFs and charts in the present day from 2016. A quick refresher on Fibonacci retracements. This is the S&P 500. This is 2009 here. Here's the low where the new trend starts in March of 2009. We get a big move off of the low. Here's our A to B. We can calculate our fibs based on this move, A to B. We get a retracement here that lasts several weeks, but the retracement stays above all three of the major fibs, telling us, based on the fibs, this is a normal pullback within the context of an ongoing trend. And what's important about that, if this is a normal pullback within the context of an ongoing uptrend, it implies that a new high will eventually be made. And if you hold your position as we fall here, and the uptrend does indeed resume, then eventually these losses will be regained and profits will be added on the other side. And that's exactly what happened in 2009. Therefore, let's look at several markets and look at some A to B moves. and see where price stands relative to the fibs. Does it look like a normal retracement within the context of an ongoing trend, telling us if we're patient and the uptrend does indeed continue, that good things will happen? Also note, 2009, we get a lower high relative to this high in the S&P 500, and this is a lower low relative to this low. So this is a little bit of a mini downtrend here, but the primary trend was still up. There was also a somewhat ominous looking head and shoulders pattern here, and the neckline was even broken here, and then eventually stocks rallied and resumed the uptrend. Meaning we have to look at the weight of the evidence, not just a chart pattern or not just one series of a lower high and a lower low. That's meaningful, and this is meaningful, but we have to look at the weight of the evidence. We're going to cover numerous 2016 charts, and what we cover will basically be the same on all of them. This is SPY, the S&P 500 ETF. This is the low in 2016, so this can be classified as an A to B move. And we can also classify the Brexit low as an A to B move. The Brexit Fibonacci retracements are shown in green, and the Fibonacci retracements from this A to B move are shown in blue. In red, we have the 200-day moving average. So in terms of this pullback in SPY, it hasn't violated any of the Fibonacci retracements, meaning it has potential support below, and the slope of the 200-day moving average still looks healthy, telling us right now from a mathematical perspective, the longer-term uptrend remains intact on Friday, October 21st at 10:21 a.m. How does this look here compared to a high-risk look in SPY? Here's the same 200-day moving average. You can see it's positive here. It flattens out and rolls over. After that, when price drops below and it rolls over, the probability of bad things happening is higher here, and indeed, very bad things happen in 2008. The present day look really doesn't look anything like that. We have a downtrend here, a bottoming process, and we're turning up. Metals and mining stocks, XME in the ETF world, same exact principles, A to B. Here are your fibs. It hasn't violated any of them yet, and the slope of the 200-day remains positive. This is the high-risk look that we want to avoid in XME. This is the 200-day rolling over in 2000. After that, really bad things happened. You can see the present-day look of the 200-day really doesn't look anything like this high-risk period here. Is it possible that this chart morphs into something like this? The answer is absolutely positively yes, and that's going to be true on all of the charts that we're looking at. But we need to see that. We don't want to anticipate it, and right now this looks like a normal retracement within the context of an ongoing uptrend. Gold, similar situation here, GLD, long-term downtrend, 200-day moving average turns up. The slope of it is still up. Price is coming back and testing it. And our fibs from A to B, we have a normal retracement here. We've retraced 38.2% of this move from here to here. Is it possible the GLD takes out all three of these fibs and the 200-day rolls over? Yes, it's possible, but we don't have that now. If anything, this looks like a favorable entry point for GLD rather than cutting back. We'll see what happens over the next few weeks. Here's the peaking process here for GLD in 2012. Really bad things happened after this peak here. And you can see the 200-day moving average was helpful. It's flattening out here, and then it rolls over, and really bad things happen in 2013, 14, and 15. The present day, this is the 200-day here. The slope of it really doesn't look anything like this higher risk period in here. Midcaps, MDY, A to B move in 2016. Here's the A to B move. This is the Brexit low here. A to B. Here are your green retracements based on this low. Here are your blue retracements based on this low. Thus far, it has not violated any of the fibs, and the slope of the 200-day moving average still looks favorable, and quite a bit better than the slope of the 200-day moving average during this higher risk period in late 2007. If anything, the present day looks more like this bullish turn here in 2009 in the 200-day. A trough and a turn up, a trough and a turn up. Equal weight S&P 500 has not violated any of the green fibs yet, nor has it violated any of the blue fibs yet. These might act as potential support, and the slope of the 200-day moving average remains clearly positive, which really doesn't look anything like the high-risk period here when it rolled over in late 2007. SDY dividend stocks, we're using this A to B here and this A to B here. You can see the fibs are down in this area here. Here are the green fibs, here are the blue fibs. These would be normal retracements. You can see we've got some white space in here. There's a 200-day moving average. It's possible, even within the context of an ongoing uptrend, that we might fill this white space here. But the longer-term trend, based on the fibs and the slope of this, still look pretty good, and quite a bit better than this high-risk period in SDY in 2007, and then bad things happened into 2009. Bonds TLT, if we use this low here and this high here, we've got the fibs in blue below. We also have potential support in the form of a rising and bullish 200-day moving average. Present day really doesn't look anything like this higher risk period here in 2013 where my cursor is, and after the 200-day rolled over, really bad things happened for quite a long period of time. This is several months here. Similar concepts, REITs, A to B, we're in the fibs now. A normal retracement might come back to this line, or this line, and that falls into the typical retracement category. And price has come back, and it looks like it's trying to retest what is an upward sloping 200-day moving average. It's possible that this is trying to flatten out and roll over, but it hasn't done that yet. The present day look here looks quite a bit better than this higher risk period here in 2007, and after that, REITs dropped from the 50s, the ETF, all the way down to 15. Energy stocks, XLE, this is 2016 here. Our A to B move are above all three of these fibs, and you can see this is a nice look on the 200-day. It looks like it's trying to turn back up, which is quite a bit better from a probability perspective than this period here in 2008 when it flattened out and rolled over, and after that, price came up and retested it and failed, and really bad things happened into early 2009. Small caps, ticker symbol IWO, ETFs, A to B move here, A to B move here. We're still above the green Brexit fibs, and we're still above all three fibs based on the low earlier in 2016. We also have a favorable trying to turn look in the 200-day moving average. It's fair to say the present day here, the present day look of the 200 looks a lot more like this bullish turn in 2009 than this bearish turn in late 2007, early 2008. Global stocks, same old song and dance, above the green fibs based on this low, above the blue fibs based on this low. 200 days slope has somewhat of a similar look to the 200's bottoming process here in calendar year 2009 when the new bull market started. Silver, if we look at the A to B fib here, we're down to the 50% retracement that is intersecting with an upward sloping, positive and bullish bias 200-day moving average here. You can see it's acting as potential support. We'll learn something either way for silver SLV. Does this look like a very high risk period? It may morph into one, but this is a higher risk period here. The slope of the 200 is flat to negative here. It rolls over in calendar year 2013. Price drops below it. And after that, a longer-term downtrend takes place in 2013, 14, all the way through to year end in calendar year 2015, bringing us to calendar year 2016 and what looks like the beginning of a potentially new longer-term bullish trend. Same situation with VGT, 11:20 a.m. Friday, October 21st. Above the green and the blue fibs, the 200-day still looks healthy. Drop and this flat look here and the turn back up, while obviously not as pronounced as this turn down here, but the present day here from a slope perspective definitely looks more like this period here than this period here in early 2008. Emerging markets above the green and the blue fibs, and we've got a nice positive turning look in the 200-day. Present day turn here looks a lot more like this positive turn in 2009 than this higher risk turn down in 2007. Dow Industrials ETF DIA is the ticker symbol. It's above the green and the blue. Fibonacci retracements telling us thus far this looks like a normal retracement within the context of an ongoing uptrend, which would imply a new high eventually would be made above point B here. The slope of the 200-day looks more like this favorable turn here than this unfavorable turn in 2007. S&P 500 as of the close on Friday, October 21st. We covered this chart last week. Everything we said last week still applies. For now, we're holding above. A normal retracement might take us down to 2068. We closed on the 21st at 2141. The weekly chart that we've been looking at, again, as of the close on Friday, October 21st. Over the last 5 trading sessions, the S&P 500 was up 8 points. We still closed above the top of the weekly box here. If these levels give away on a weekly basis, these levels here might act as possible support. This low here has never been retested, so it's possible, even under a bullish scenario, we could come back and revisit this low here. It's also possible that we hold the top of the box. All of that is to be determined. No real change to our, for illustrative purposes only, longer-term weekly moving averages, the 30, 40, and 50 week. We still have a full-bore bullish look under that hypothetical scenario. This looks like a long-term trend change in a bullish manner. You all remember from calendar year 2015 that 2100 was relatively important. On the monthly chart, the monthly box sits, the top of the box, around 2100. It's just good to keep in mind if we see additional weakness. The close on the 21st was 2141. There's only a few trading days left in the month of October, and we'll see what this looks like at the end of the month. The top of the box could act as possible support. In the world of money management and trading, it's extremely important to keep your confidence intact. If you're trading your own account, it might be helpful to know that this has been an extremely difficult market for some of the brightest of the bright. This is text here from a Bloomberg article, October 21st, 2016, that talks about the struggles in the hedge fund industry. Some name managers are down over 20% this year, others down about 10%. It's been an extremely difficult market. It's important when we're in a difficult market, we must understand why it's been difficult. If you don't understand under your system why it's been difficult, then you probably have a problem. In our case, it's been difficult because we're trying to identify long-term trends, and the stock market has been inside of this box. It entered the box here back in 2013. So when we look at a chart like this, this isn't particularly favorable for our approach, and it's not really surprising that our approach has struggled under this environment, just as many of the hedge fund managers have struggled in this environment. That's the bad news. But the good news is we also know that the longer you go sideways, the bigger the move that you can expect to get when you see a breakout. Just to refresh our memory here, the longer you go sideways, the bigger the move that you can expect to get. This is a 23% gain here after price broke out of this long-term box. In this case, price went sideways within 2 boxes for a long period of time after it broke out of the box here. From here to here, that was a 15% gain. And this is an extremely frustrating period here in 1993, 1994. This tells us that price was in the exact same place here as it was 675 calendar days ago. It's an extremely frustrating period. But after that, if you executed properly, it broke out of the box in this case, the market went up almost 36% from this point here to this point here. How does this 675 days compare to the difficult market that we've been experiencing in the present day? It's almost twice as bad. Price entered the box here 1,236 calendar days ago. The NYSE has been inside of this box for over 3 years. And we know from previous videos that the S&P 500 has already broken out of its long-term consolidation box, and the longer it holds, the better it is from a probability perspective, telling us it's possible that this is the longer that we go sideways, the bigger the move that we can expect to get. For now, the breakouts are still in place here. We'll see what happens over the next few weeks. In these instances here, it would have been terrible if you abandoned your approach here just before good things happened. If you stuck with the approach here, you were eventually rewarded. If you stuck with the approach here, eventually patience and frustration were rewarded. Therefore, it's important that we head into next week with that always important, flexible, unbiased, and open mind. Focus on what we can control, execution, and our attitude, rather than the things that we can't control. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog Short Takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.